You've got company RSUs vesting this year. Maybe some options you're thinking about exercising, but no one has ever shown you how those decisions actually flow through your taxes. So you're left reacting to what happens instead of planning for it. And that's the difference between staying in control and getting hit with tax surprises that could have been avoided. In this video, I'm going to show you how each type of company stock actually creates income and why it doesn't all happen when you sell. The exact moments where taxes are triggered across RSUs, ISOs, NSOs, and ESPPs, and how to think about all of it together so you can plan ahead instead of reacting after the fact. Imagine trying to keep track of 4 different clocks, and none of them are synced. One is running fast, one is delayed, one only moves at certain times of the year, and one randomly jumps forward. That's essentially how company stock works. RSUs, options, ESPPs, each one follows its own timeline for when income is created and when taxes show up. And if you don't know which clock you're looking at, you're not really planning. You're just guessing. Most people think about company stock like this. I'll deal with the taxes when I sell. The problem is that's not how most of this actually works. Because with equity comp, taxes show up at different points depending on what you're doing. Sometimes it's at vesting, sometimes it's when you exercise, sometimes it's when you sell. So if you're only thinking about the end result, you're missing where the taxes are actually being created. Here's how to think about it instead. Every equity decision lives on its own timeline, and there are really 3 things you need to track on that timeline. First, when is income created? Second, when is your cost basis established? And third, what portion becomes capital gains? Once you understand those 3 pieces, everything else we're going to go through, RSUs, ISOs, NSOs, ESPPs, start to make a lot more sense. Let's start with RSUs because this is usually the most familiar and common, and also where people get a false sense of simplicity. RSUs vest, shares show up, some get sold to cover taxes, and it feels like everything's already been handled. But there's a second layer here that most people don't realize. Because when your RSUs vest, that value is treated as ordinary income. That becomes your cost basis. Step 1 and step 2 happen almost simultaneously. But if that cost basis isn't tracked correctly or reported correctly, you run into a serious issue. Far too often, I've seen the brokerage company report a $0 cost basis. And when that happens, the IRS treats the entire amount as taxable when you sell. You get slammed with paying taxes twice. You paid tax once when the shares vest and again when you sold. And many times, this just slips through the cracks because it's not always obvious unless someone is specifically looking for it. And the frustrating part is you didn't do anything wrong. This often comes down to how it's reported if no one catches it. Now layer on top of that, most companies only withhold 22% for federal taxes. But if you're already in a higher income bracket, 32%, 35%, even 37%, you're building a gap in withholdings. So even in the scenario where everything seems automatic, you can still end up under withheld and potentially dealing with reporting issues on top of that. And this is something I spend a lot of time helping clients plan around ahead of time. With ISOs, the biggest mistake people make is assuming if I don't sell anything, I don't owe any taxes. And that's not always true. When you exercise ISOs, the spread between your strike price and the current fair market value can be used to calculate alternative minimum tax, or AMT. So even if you don't sell a single share, you can still create a tax bill. This is where people run into what I call a tax without cash problem. Let me give you an example. An individual exercises a large batch of ISOs, completely within the rules of their plan. At the time, the spread was around $200,000. They didn't sell the shares. They were planning to hold for the potential upside. But that $200,000 spread was used in the AMT calculation. The stock dropped the following year, so now they had a tax bill tied to income they never actually received, and an asset that was now worth less than when they exercised. This is where understanding the timeline really matters. With ISOs, you're not just deciding if you should exercise, you're deciding when and how much. And that's where the strategies like partial exercises come into play. Instead of exercising everything at once, you can spread that decision across multiple years, manage how much income shows up at a time, and reduce the risk of creating a large AMT exposure all at once. Up to this point, you might be thinking, okay, I just need to understand how each type works. But here's where people start running into real problems. It's not just how each one works individually. It's what happens when they start stacking on top of each other. And NSOs are usually where this becomes very obvious. Because when you exercise NSOs, the spread between your strike price and the current fair market value gets taxed as ordinary income. So let's say you already have a $300,000 salary, a $100,000 bonus, and then you exercise NSOs with a $200,000 spread. Now your taxable income for the year isn't $300K or even $400K. It's $600,000. And that income doesn't just sit in a vacuum. It stacks on top of your highest marginal tax bracket, which means a large portion of that is getting taxed at some of the highest tax rates you'll pay. And on top of that, NSO income is treated like compensation. So you're also dealing with payroll taxes, and just like with RSUs, withholdings often doesn't fully cover what you actually owe. So again, this isn't about whether you exercise, it's about when you exercise, because the timing of that decision can have a massive impact on your total tax picture for the year. Now, ESPPs are usually viewed as the simplest of the group. There's a potential for a discount, maybe there's a look-back provision, and it feels like an easy win. And in a lot of ways, it is. With that discount and look-back, you can have a built-in gain the moment you purchase the shares. But the part that gets missed is how that gain is actually taxed, even in what's considered a qualified disposition. Part of that gain is still treated as ordinary income. Not all of it gets capital gains treatment. So if you're thinking, I'll just hold on to these shares for better tax treatment, it's not as clean as it sounds. There's usually a mix of ordinary income and capital gains. And then if you sell early, which is called a disqualifying disposition, even more of that gain gets pulled into ordinary income. Now layer in the look-back provision, you're buying at the lowest of two prices, plus a discount, which can amplify the gain, but also amplify the taxable portion tied to compensation. And all of this is assuming that the stock went up in value from the beginning of the purchase period to the time you sold. If the stock goes down in value, there's a whole other set of rules to follow. So while ESPPs can be a great benefit, you still need to understand where taxable events happen and how much of that gain is actually being treated as income versus investment return. This is where everything starts to connect. Up to this point, we've looked at each type individually: RSUs, ISOs, NSOs, ESPPs. But in real life, these don't happen in isolation. They have a potential to all show up in the same year. Taxes are calculated on the total picture, which means one decision, like exercising options, doesn't just live in a vacuum. It can change how everything else is taxed. That's why this isn't just about understanding each piece, it's about coordinating them. Because when you start looking at all this together, you begin to control when income shows up and how much hits in a given year. And that's where planning starts to make a real difference. You've gone from reactive to proactive. Now, taxes and cash don't always show up at the same time. And this is where a lot of this starts to feel real. You can create income on paper without actually receiving cash to pay the tax. We already saw this with ISOs. You exercise, trigger AMT, and now you owe taxes even if you didn't sell anything. With RSUs, you might have shares sold to cover taxes, but if you're under withheld, you still owe more later. So across all of these, you can end up in a situation where your tax liability is higher than the cash you've actually set aside. And that's where people get stuck. Now, it's not just a tax problem, it becomes a cash flow problem. And if you're looking at all of this and realizing you don't have a clear plan for how these pieces fit together, I offer a free equity evaluation where I walk through your RSUs, ISOs, NSOs, ESPPs, and cash flow to answer your questions and help you get clarity on what to do going forward. Schedule that through the link in the description. There's also one shift that can make all this more manageable. It's this. Most people think about taxes once a year, but when you're dealing with equity comp, that's not enough. Events like vesting, exercises, and sales are happening throughout the year. So instead of reacting once everything has already happened, you want to start thinking in quarters. Looking ahead and being strategic, you want to think about when RSUs are scheduled to vest, when you might exercise options, when bonuses or other income will hit, and then adjust around that. That could mean increasing withholdings, making estimated tax payments, or shifting the timing of a decision into a different year. When you start planning throughout the year instead of after the fact, you give yourself the ability to actually control the outcome. Let me show you what this looks like in real life. I've seen someone in a single year have RSUs vest, exercise options, and receive a bonus. And on the surface, everything looked fine. Taxes were being withheld, decisions were being made, nothing seemed out of the ordinary. But none of it was being looked at together. So when tax season came around, they ended up with a surprise tax bill over $30,000. Not because they did anything aggressive, not because they made a bad decision, but because they didn't realize how all of those events were stacking on top of each other. And that's really what this comes down to. It's not about avoiding taxes, it's about understanding when and how they're created before they show up. If you step back from everything we just covered, there are really three mistakes that cause most of the problems. First, assuming taxes are already handled, and surprise, they're not. This shows up with RSUs, NSOs, even ESPPs. There's some level of withholdings, so it feels like it's being taken care of. But as we've seen and discussed, there are often gaps or reporting issues that still need attention. Second, not understanding when income is actually created. Thinking it happens when you sell, but in reality, it can happen at vesting, at exercise, or even at purchase. And if you don't know when that moment is, you can't plan for it. And third, making decisions in isolation. Looking at RSUs separately from options or options separately from your salary and bonus, when in reality, it's all connected. And that's what leads to income stacking, higher tax brackets, and the unfortunate surprise tax bill. At the end of the day, this isn't about trying to outsmart the tax code. It's about understanding how these decisions actually work before you make them. Because once you see how the timelines connect, you can start making decisions with intention instead of reacting after the fact. And one of the biggest pieces that start to matter once you get this right is what happens next when you actually sell. Because that's where capital gains come into play. And depending on how and when you sell, it can impact your tax bracket more than most people realize. So if you want to understand how capital gains actually work and whether they can push you into a higher tax bracket, click right here to watch that next video.